stop what you're doing for a second, because the market is sending a message so loud it's basically a siren. Gold is ripping, silver is acting possessed, and at the exact same time, the AI trade is sprinting, like it just got a second set of lungs. And if you think that can't happen all at once, you're about to see why this is the weirdest, most profitable, most dangerous mix we've had in years. All right, here's the situation. Gold didn't just go up. Gold punched through a psychological wall, blew right past it, and then kept running as if it didn't even feel the impact. We're talking about a market that was already strong, already trending, and then suddenly, boom, accelerates into a whole new gear. And silver? Silver didn't walk through the door. Silver kicked the door off its hinges and started yelling. It cleared levels that for a long time felt like fantasy talk. The kind of numbers people whispered about in comment sections, not the kind of numbers you actually see flashing on a real chart. Now, if you're thinking, okay, that means the economy must be collapsing, hold that thought. Because here's the twist. The stock market, especially the tech side, is also acting like it's staring at a golden age. So the classic story, metals up because everything else is dying, doesn't fully explain what's happening. So what does? That's where we're going today. We're going to connect the dots between the metal move, the currency tension underneath it, and the AI boom that's pulling capital like a gravity well. And there's one hidden pressure point in all of this that could flip the entire narrative in a single week. Don't miss it. Also, check the description after you watch because I've put bonus links down there, including a premium WhatsApp channel link and a channel membership join link. If you want the faster updates and the behind-the-scenes breakdowns, it's there. Now, let's start with gold because it's the headline and it deserves it. When gold makes a move like this, there are usually two forces working together. One is the visible force, price momentum, positioning, trend followers, the crowd waking up late and piling in. The other is the invisible force, the reason people suddenly feel like they need a neutral lifeboat. And that neutral lifeboat point matters, because gold is not a company. It doesn't release earnings. It doesn't launch a new product. It doesn't promise you anything. It just sits there and reflects the fear, the skepticism, and the long-term math. And the long-term math right now is ugly. We've been living in a world where governments learned they can run deficits forever as long as the market keeps buying the paper. And for a long time, the market did. People accepted it. They shrugged and said, that's just how it is. But here's what changed. The scale and the speed of the borrowing have become impossible to ignore. Recently published numbers put total gross U.S. national debt at about $38 trillion. That's not a political statement. That's just the scoreboard. And when the scoreboard looks like that, it creates a very specific incentive for every major player on Earth. Diversify. And yes, some of that diversification is happening through central banks. Based on recently published numbers, central banks collectively bought hundreds of tons of gold last year. That's not a small side bet. That's an ongoing strategy. But here's where a lot of people get confused, and I want you to really hear this. Central banks don't buy gold because they think gold is going to go to the moon. They buy gold because gold is politically boring. It doesn't come with someone else's rules. It's a reserve asset you can hold without asking permission. And in a world where financial systems are increasingly used as leverage, sanctions, restrictions, access controls, boring becomes valuable. Now the competitor story you're going to hear everywhere is gold is up because the dollar is finished. That makes for a catchy narrative. It's also too simple. Here's my skeptical take. The dollar isn't going to vanish overnight, and anyone who tells you it will is selling you drama. The reason the dollar stays dominant isn't just tradition, it's plumbing. The world runs on deep, liquid markets where you can park enormous sums without breaking the system. That infrastructure is still unmatched. But, and this is the part people miss, dominance does not mean stability. Something can remain the main system and still lose purchasing power. Something can remain the default and still be resented. Something can remain the best house in a bad neighborhood and still have termites in the foundation. So gold can rally hard even if the dollar remains the operating system. Now, to keep this grounded, I want to replay a conversation I had recently with a veteran money manager. Not naming names, because it's not about clout, it's about the logic. I asked him one question. If gold is exploding, what's the actual trigger? What changed this month? And his first answer surprised me. He said, nothing changed overnight. What changed is that people finally stopped pretending the old rules still apply. Then he pointed out something that sounds obvious, but most people don't internalize. The debt math isn't just large, it's compounding, and compounding is quiet until it isn't. Then I pushed back. I said, okay, but we've had big debt for years. Why does the market care now? And he said, because now the buyers are different. That's a crucial point. In past runs, a lot of the marginal buying came from Western investors chasing performance. That money is fast, emotional, and it leaves as soon as the chart rolls over. This time, a big slice of the marginal buying is structural. It's reserve managers. It's institutions that aren't trying to flip a move in 2 weeks. They're trying to reduce exposure to political risk over 10 years. And if you zoom out, that reserve behavior hasn't been a one-year fad. Even when annual totals cool off from the peak, the message is the same. Gold is back on the checklist. Now here's where the conversation got even more interesting. He said, people keep asking, can something replace the dollar? That's the wrong question. And I said, okay, what's the right question? He said, the right question is, how much of the world's savings needs to be stored somewhere that isn't someone else's liability? That's what gold is. It's not a liability. A bond is a liability. A bank deposit is a liability. Even a lot of safe stuff is somebody else's promise. Gold is one of the few financial assets that doesn't start with the words, trust me. So no, I don't think we wake up one morning and the dollar is gone, but I do think we're watching a slow drift where more wealth gets parked outside the dollar-based promise stack. That's not a collapse story. That's a rebalancing story. And rebalancing stories can run for a long time. Then I asked him the question you're probably asking me. So is it too late? And his answer was the most honest answer you can get in markets. It depends on your time horizon. If you're trying to buy the exact bottom and sell the exact top, you're going to get chopped up. But if you're treating gold like long-term insurance against policy mistakes, you don't need perfection. You need consistency. And that's why I keep repeating, the biggest risk in a move like this is not being wrong about the direction. The biggest risk is being right about the direction and still losing money because you get shaken out on a pullback. Because pullbacks will happen. Gold doesn't climb like an escalator. It climbs like a staircase with missing steps. So when someone tells you gold can only go up from here, that's when you should get cautious. The better stance is gold is trending and the trend will be tested. And by the way, one more historical point because it helps frame what tested looks like. Gold has had periods where it runs hard, then goes dormant for years. That dormancy doesn't mean gold failed. It means the rest of the market caught up, or inflation cooled, or rates changed, or risk appetite returned. The trend paused. The story didn't vanish. So if you're positioned, you respect both possibilities, a continued grind higher and a long sideways digestion that punishes impatience. And that's why I don't buy the either-or framing. This is not a movie where only one asset survives. Now, let me bring in a second force behind gold's move, the mechanical force. Markets today are not just humans making decisions. A huge portion of volume comes from systems that chase signals. Trend, volatility, breakout levels, positioning, rebalancing, momentum. And when a market crosses a well-watched threshold, those systems can turn a push into a shove and a shove into a stampede. So, in plain English, once gold broke a major level, the machines helped fuel it. But machines don't care about your feelings, and they don't care about your cost basis. They can push price up fast, and they can also yank price down fast if the signal flips. That matters, because we're now in a zone where the next headline can cause a violent reaction. And that's why I'm going to tell you something that might sound contradictory. I'm bullish on the long-term case for gold, and I'm also respectful of short-term pullbacks. Both can be true. Because gold has a history of doing this thing where it explodes, everyone declares a new era, and then it goes sideways for a long time. Not because the story died, but because the market needs to digest. So what would make gold stall? One obvious answer is a sudden surge in the dollar. And that brings us to the part of the story nobody wants to talk about because it's boring until it becomes terrifying. Liquidity. If liquidity gets squeezed, everything feels it. Gold, stocks, crypto, everything. And there's a big political catalyst that can affect liquidity fast. Government funding drama. A shutdown fight, a funding standoff, delayed spending. People treat it like theater, but the plumbing doesn't care if it's theater. If money doesn't flow, liquidity tightens. In a funding freeze, cash becomes scarce in the system, and scarce cash does something weird. It makes the dollar look stronger even if the long-term fundamentals are weak. That short-term dollar strength can smack gold in the face. So if you're watching this and you're thinking gold is unstoppable, I want you to keep one eye on that. Not because it changes the long-term trend, but because it can create a nasty drawdown that shakes out the impatient money. And that's the first cliffhanger. What happens if Washington accidentally manufactures a short-term dollar squeeze? That could decide whether gold runs straight to the next milestone, or whether it takes a painful detour first. Now, before we go to silver, let's address the question everyone is asking quietly. How high can gold go? You'll hear wild numbers thrown around. Some people say 6,000, some say 7, some say it's just getting started. Here's how I think about it. If the buying stays persistent, especially the steady, non-speculative buying, gold can keep trending. But the bigger the move, the more sensitive it becomes to any shift in rates, currency, or sentiment. So the higher it goes, the more you have to think in terms of phases. Phase 1 is the breakout. That's where we've been. Phase 2 is the everyone notices. That's when mainstream attention hits and late money pours in. Phase 3 is the blow-off risk. That's when price becomes the story and the story becomes the trap. Are we in phase 2? It sure feels like it. And that's not an insult. It's just market behavior. Now, let's talk about a development that could accelerate the gold story in a way most people aren't ready for. There are countries that store part of their gold reserves outside their borders, in big financial hubs, for historical and logistical reasons. But geopolitical trust is not what it was 10 years ago. And in that environment, you're seeing louder public debates about repatriation, bringing gold home. Here's why that matters. The moment large players start moving physical gold, it stops being a theoretical hedge and becomes a strategic asset. It sends a message. We don't want our insurance stored in someone else's house. And if that trend accelerates, it's not just symbolic. It can tighten the physical market, alter leasing dynamics, and intensify the perception that gold is becoming more important as a reserve anchor. Now, I'm not here to feed you conspiracy soup. I'm not going to sit here and claim I know what's in any vault. But I will say this. The louder the calls for transparency get, the more the public realizes gold is not just a chart. It's politics, it's trust, it's national security, it's leverage. And that sets the stage for the next question. If trust is fraying and gold is the neutral asset, what happens to silver? Because silver is where this story gets spicy. Silver is not just little gold. Silver is the metal that can trade like a commodity, behave like a monetary asset, and then suddenly get hijacked by supply constraints. It's the one that can go calm for years and then go insane in weeks. And that's exactly what we're watching. Silver has been surging faster than gold, and that's not unusual in late-stage precious metals moves. Silver is smaller, thinner, and more emotional. When it catches a bid, it can move like it has a jet engine, but this time there's an extra ingredient. Industrial demand that isn't optional. Silver is used in electronics, power systems, and manufacturing in ways that don't disappear just because price goes up. And with the world building more data centers, more power infrastructure, more electrification, and more advanced equipment, the baseline demand isn't shrinking. Here's a fresh piece of context that matters. Global electricity use from data centers is projected to roughly double by the end of the decade. That's not just AI is popular. That's AI is physically hungry. And hungry systems need wiring, connections, components, and hardware. Not all of that is silver, but silver shows up all over the stack. So when someone tells you silver's move is just speculation, I'm not buying that. Yes, speculation is part of it, but there's a real-world demand story under it that didn't exist at this scale in prior cycles. Now, the competitor angle you'll hear is the meme stock analogy. The idea is paper promises versus physical reality, a squeeze dynamic, and price goes vertical. There's some truth there. When too many people are short a thing and physical supply is tight, price can rip as shorts scramble. That's market physics. But here's my counterpoint. Silver is not a toy. Silver isn't a short-term prank. Silver has a history. It has a real industrial pipeline. And if the market is finally forcing a reprice because the old pricing model assumed abundant supply, then you're not looking at a one-time meme event. You're looking at a reset. Does that mean silver only goes up forever? No, markets don't do that. But it does mean the fair value debate is real now. So how do you handle it? This is where I'll be honest. Silver is harder to manage emotionally than gold, because silver can give you profits and then take them back fast. And if you're not prepared for volatility, you will do the worst possible thing at the worst possible moment. So instead of giving you a fantasy number, I'm going to give you a framework. If silver goes parabolic, you respect the move, and you also respect the possibility of a sharp pullback. If you're sitting on big gains, you don't have to choose between sell everything and sell nothing. You can scale, you can trim, you can protect your base, you can breathe. And here's something else that matters. Silver's market is more sensitive to liquidity shocks. If we get a dollar spike from a liquidity crunch, silver can drop harder than gold, even if the long-term story remains intact. So once again, we're back to the same cliffhanger. The metal story and the liquidity story are intertwined. Now, let's zoom out for a second because I want to address the question that's probably already forming in your mind. How can gold and silver be screaming higher while the AI stock trade is also ripping? Isn't that contradictory? It feels contradictory if you treat markets as a single mood. But markets are not a single mood. Markets are multiple games happening at once. Gold and silver are responding to the long-term math in the trust environment. AI stocks are responding to a profit story that is unlike anything we've seen in a generation. Both can be true. And in some ways, they feed each other. Because the more AI accelerates, the more energy and infrastructure spending ramps, the more the commodity complex gets dragged along. And the more money gets created or redirected to fund that build-out, the more people question what their cash will be worth in 5 years. That's where metals live. So this isn't a pick one environment. It's a understand the layers environment. Now, speaking of layers, we need to talk about one of the most underappreciated risks sitting under global markets right now, the yen carry trade. Here's the simple version. For years, borrowing in yen was cheap. So traders borrowed yen, converted it, and bought higher yielding stuff elsewhere. It's not glamorous, but it's been huge. The problem is, if Japan raises rates and the yen strengthens, that trade gets squeezed. And when a crowded trade gets squeezed, people unwind. Unwinding means selling. And that selling doesn't stop at one asset. It spills. Recent market updates show Japan's central bank has already raised its policy rate, and the market is watching for more tightening. That matters because the whole carry structure depends on stable, cheap funding. Now, do I think this automatically crashes the world? No, that's the clickbait version. Here's my more realistic take. The carry trade is a volatility amplifier. If Japan moves slowly and communicates clearly, markets adjust. If Japan surprises, markets lurch. If markets lurch at the same time, liquidity is tight for other reasons, the lurch becomes a stumble, and that's where you get the kind of week that makes people swear they'll never trade again. So what should you watch? Watch for surprise rate actions, watch for sudden yen strength, watch for signs of intervention chatter, and watch for correlation spikes, when everything starts moving together in the wrong direction. Because if the carry trade unwinds aggressively, it can hit high beta tech stocks first, and then it can hit everything else as people raise cash. And that brings us to the next beat in this story, the U.S. macro outlook. There's a growing camp of investors who believe the United States is entering a powerful multi-year phase of productivity, growth, and capital attraction. The argument is simple. AI, reshoring, energy build-out, deep markets, and the rule of law create a magnet. Even if you don't love the politics, the capital can still flow. Money doesn't vote, it hunts. And I get that thesis. In fact, parts of it are hard to argue with. AI isn't a trend anymore. AI is a re-architecture of how businesses run. It's moving from cool demo to core workflow. And when that happens, spending doesn't trickle, it floods. Think about what AI requires. It requires compute. Compute requires data centers. Data centers require energy. Energy requires grid upgrades. Grid upgrades require materials, labor, and capital. And capital requires financing. That chain reaction is why you can have a bullish equity story at the same time as a bullish metal story. Now, let me give you another fresh detail that most people don't connect: the energy response. We're seeing a rapid ramp in planned power generation tied to data center demand, and a lot of that is gas, because gas plants can be built faster than some alternatives. That means the AI boom isn't just a software story, it's also a real asset story. And when real assets become strategic again, commodities stop being an afterthought. Now, here's the part that makes people uncomfortable, and it's where I'm going to challenge the rosy narrative a little. AI-driven productivity can be incredible, but it can also be disruptive. When processes get automated, some roles get squeezed. The transition can be messy even if the long-term outcome is positive. So if you're betting on a smooth, painless AI boom, I'd caution you. Even big positive transitions have turbulence, and turbulence is exactly when gold tends to stay bid. So instead of asking, is gold bullish or are stocks bullish? The better question is, are we entering a world where capital flows to both hard assets and high-margin tech at the same time? That sounds strange, but it's not unprecedented. In some periods, both can run, especially when the denominator, currency purchasing power, is getting diluted. Now, let's bring this back down to practical reality. If you're sitting there and you've made money in metals, or you've made money in tech, or you've made money in both, I want you to do something simple. Don't get arrogant. This is the market environment where arrogance gets punished. If you're successful, share your success story in the comments so others can stay motivated. Now, we've talked about the big picture. Let's get more specific, because I know a lot of you want actionable clarity. First, gold. I think the long-term case remains strong because the debt math, the geopolitical mistrust, and the reserve diversification trend aren't going away in a month. But the short-term path can be violent. A sharp dollar spike, a liquidity squeeze, or a sudden shift in rate expectations can create a brutal pullback even in a bull market. Second, silver. I think silver has both a squeeze component and a demand component. The squeeze can fade, but demand doesn't disappear. So I'm not treating silver like a pure meme event. I'm treating it like a volatile asset that might be repricing into a new zone. Third, the dollar. I'm not in the dollar dies tomorrow camp. I'm in the dollar remains dominant but gets chipped away at the edges camp. And the edges matter because edges are where reserve preferences change and where long-term pricing shifts. Now, here's the payoff loop I promised you earlier, the hidden pressure point that could flip the narrative in a single week. It's the combination of a funding fight and a yen shock. If the U.S. runs into a political funding mess that tightens liquidity at the same time Japan surprises the market and the yen strengthens, you could get a synchronized risk-off move. In that scenario, gold might dip at first because cash gets scarce, but then gold could rebound hard as fear rises. Silver could get whiplashed, tech could get hit, and the people who weren't prepared could panic. That's the blink and you miss it week. Now, on the flip side, if funding gets resolved smoothly and Japan telegraphs its moves, liquidity stays healthier, and then you might see the metals trend continue while AI stocks keep climbing. That's the everything up, but for different reasons. Environment. Which one happens? That's why you watch the next headlines like a hawk. Now, I also want to talk about one more thing that's sneaking into this conversation. The idea that gold is becoming less of a fringe hedge and more of a core asset allocation. In past cycles, gold was often treated like an insurance policy, something you buy and forget. But as reserves shift and as institutional positioning evolves, gold starts getting treated like a strategic allocation. That changes the flow profile. And flow is everything. Because if gold is owned mostly by long-term holders, it doesn't take much new demand to push price higher. But if gold becomes over-owned by short-term chasers, it becomes fragile. So watch who is buying, not just what the price is doing. Now, let's pivot back to the equity side, because I promised you we'd connect the AI boom without turning this into a tech commercial. Here's what's real. AI is driving a massive build-out, and the companies enabling that build-out are sitting in the center of the money river. Chips, networking, power management, cloud infrastructure, data pipelines, and the software that makes all of that useful. The big mistake people make is they assume all AI winners are the same. They're not. Some are hardware, some are infrastructure, some are data, some are applications. And as the industry shifts from training models to deploying agents, the winners can rotate. And that's why you can see a stock that looks expensive keep going up, because the earnings power is being underestimated. Now, I'm not going to sit here and throw a list of tickers at you like confetti. That's not the point. The point is to understand the funnel. The funnel is data in, compute, output, then action. Whoever controls the choke points in that funnel gets paid. Now, let's tie this back to metals one more time, because this is the part that's going to make some people in the comments furious. If AI accelerates the energy build-out, that supports industrial metals demand. If industrial demand stays strong, silver isn't just a trading toy. It becomes part of the infrastructure story. That doesn't guarantee a straight line up, but it changes the long-term floor. So when someone says silver is only a trade, I get the logic, but I'm not fully aligned with it. I think silver can behave like a trade and still have a structural story underneath it. And you can disagree with me. In fact, I want you to. Do you think silver's move is mostly a squeeze that fades, or do you think it's a real repricing that sticks? Drop your answer below, tell me why. Now let's talk about what to do emotionally, because that's what actually decides whether you win. In a market like this, people get addicted to the chart. They start staring at candles like they're reading tea leaves. They start refreshing prices. They start making decisions from adrenaline. Don't do that. If you have a plan, follow your plan. If you don't have a plan, you're not investing, you're gambling. And here's a simple way to build a plan without making it complicated. For gold, think in years, not weeks. For silver, respect volatility. And don't let a parabolic move convince you that gravity is gone. For AI stocks, remember that even the strongest trends correct. And corrections are where weak hands donate shares to strong hands. Now, let's touch on the membership piece quickly, because some of you keep asking for deeper dives. We do members-only videos that are produced by a separate team with more research, more charts, and more detailed breakdowns, and those are only for premium members. If you want that extra layer, the join link is in the description. And again, the description has that premium WhatsApp channel link too, so you can get quick notes when the market moves fast. Okay, back to the story. The big question is whether we're looking at a temporary burst or the start of a longer phase. For gold, the reserve and debt dynamics suggest a longer phase is possible, but the path won't be clean. For silver, the industrial build-out and the physical tightness suggest the old price regime might be changing, but silver will still try to shake you out. For AI, the spending wave suggests a multi-year build-out, but the winners will rotate and the narrative will evolve. So the real skill here is not guessing the next candle. The real skill is staying mentally stable while the market tries to pull you into extremes. Now, I'm going to leave you with a final loop that I want you to remember. When everyone is yelling, new era, be careful. When everyone is yelling, it's over, be careful. The truth usually sits in the boring middle. Trends continue, but not in a straight line. If you're successful, share your success story in the comments so others can stay motivated. And before you go, hit subscribe if you want more of these breakdowns without the hype and without the hand-holding. One last thing to watch, and this is where the next cliffhanger lives. Keep your eyes on the next few macro prints and the next round of treasury auctions. If inflation surprises hotter, rates can jump, and that can bruise both metals and high-growth tech for a minute. If inflation cools, but deficits stay stubborn, that can keep the hard assets plus AI combo running longer than anyone expects. And if an auction ever comes in weak, that's when you'll see the narrative flip in real time. So tell me, what are you positioned for? More upside or shakeout first? Comment below today. Also watch overnight funding rates, repo stress, and the yen. Those three can telegraph risk before the headlines do, and they often move before your favorite chart does by a mile. All right, that's it for today. This is educational content based on publicly available information and my own analysis, not personal financial advice. I don't know your situation, your risk tolerance, or your goals, so don't treat this like a buy or sell instruction. Use it as a starting point to do your own homework and make your own calls.